Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, welcome back, everybody, to another Roundup edition of Forward Guidance. After a couple fun side quests the last couple weeks, we had Jem Carson and then Tony Greer last week. It's a ton of fun, but we're back to the duo. Stoked to chop it up. What's going on, dude?
Yeah, not much, man. Pumped to see you in person next week. We're doing it live.
Pumped for DAS. Yeah, Digital Asset Summit next week. Don't mess around. It's coming up quick. It's going to be a ton of fun. If you don't have a ticket, you should get a ticket. And not only that, but you will be able to see us live, chopping it up for the roundup, and then also a lot of really great panels. So, we got Mohamed El-Arian. So for those that caught the interview last week of him and I, it was a really great one. We're going to be doing it live again in person on the main stage. It's going to be really great. We got the legend himself, Michael Saylor, coming. Whole lot of huge guests. And then also we're going to be doing a forward guidance meetup on Thursday. So if you are going to be at DAS, make sure you sign up for that. It's on the website. There's like a side event tab and you can sign up for that. So that'll be a good time. Come out and have some beers with Quinn and I. Should be a good time.
We'll keep the markets talk to a minimum there, hopefully.
Yeah. Don't just ask us what to buy because we don't know either because it changes every 5 minutes these days.
Yeah, truly does.
No, we do have a good idea. And I'm stoked for this episode just to, kind of catch up, throw some ideas at each other, see what's going on. There's a lot of moving parts right now, to say the very least. But the big one is that we got the inflation print today. We're recording this on Wednesday because I'm actually out Thursday, Friday before heading to DAS. So bit of an early one this week. But it was an interesting one. I'm going to pull up a couple charts. So, the big theme for this inflation print was last month, just like every January print of the last few years, we keep seeing these hot head fake prints. And it almost felt like, if we just wind back the clock to what happened on that day of that print, hot print, we saw core month over month go to 0.4% after being at 0.3 for ages. And the bond market kind of just looked past it and bond yields rallied pretty significantly in the face of a hot print. So it felt like everybody was on the camp of it just being a head fake. And that turned out to be the case. So we got the CPI print today. Core month over month came in at 0.2%, which was 20 basis points lower when rounded, as opposed to what has felt like the sticky part of core has been sitting around 0.3 for a lot of months. So it's great to see that. And again, my favorite chart that I always refer to every month is this one on the right of core services against core goods, because this is really the theme of inflation these days, is that we've seen obviously a ton of disinflation in goods, even a couple months of outright deflation there, and it's been rebounding. So you have that odds of a rebound in inflation in core goods while core services are coming down. And we saw a pretty significant stair step lower in shelter inflation, which was really great to see. And so, by all means, when you just look at the numbers, it seemed like a really great print. But you then, Quinn, you replied to a tweet of mine this morning looking at, okay, it's a great CPI print, but not a great reaction from the bond market. It completely sold off. What do you think drove that, Quinn?
I think it's the same idea from September that investors basically, when inflation comes down, it's lag data. It means the Fed is closer to being able to accommodate, and that is pro-growth and or pro-inflation. And similar to how it threw everybody off in September when the Fed cut and the bond market, the yields bottomed and the dollar bottomed. I think that's the same mechanism that you're seeing work through. And people basically saying, okay, I guess inflation is coming down. The Fed can cut a bit more and support growth a bit more. I think it's funny though, because pretty sure since Trump inauguration, long bond yields are only down like 20 bips while the equity market's down like 10. So, yeah, like if the admin's goal is getting yields down, like that's not a lot of wood that's been chopped thus far. So we'll see how their pain tolerance develops over the coming weeks.
Yeah, I wonder how they're feeling about that, because that's a big cut to equities. Like, to your point, the Dixie's down 5%, and the S&P 500 is down 9.4%. Just a complete reversal. And we've been hearing more and more that the goal of this is they want to lower 10-year yield. And they got some of that, but that's a pretty expensive cost of doing business. If you're just trying to cut equity to try to get a bond rally, doesn't seem to really working too far. And in that same vein, yeah, I'm trying to also figure out like what also caused it to sell off. And I've been looking a lot at what's this going on in other global markets. Obviously, like German bunds have just been absolutely soaring on the premise of a pretty huge fiscal unshackling there. And then same in Japan, like Japan, I was looking at a chart yesterday, I tweeted about it, but the 30-year yield in Japan is like just absolutely soaring and hitting new highs. So that has reverberations on, global markets too, where if you just think about the last like 3 years where all this capital has flown into this US exceptionalism trade has been the de facto one. And a lot of people have been hiding out, global capital has been hiding out in the Mag 7. And you start to get fiscal and shackling in these other countries, you start to get higher bond yields in those other countries. Suddenly it becomes a bit more compelling for domestic capital flow. So that's a pretty interesting one. And I'm curious your thoughts, because like a lot of that has been predetermined by what's been going on with the tariff talk, which is kind of leading these countries to start to be like, oh shit, we need to ramp up the fiscal and ramp up our defense spending. And that's actually almost going against what they're trying to do here, which is to lower yields, right? So yeah, like how do you think Bessin's thinking about these surging yields?
All these things come back to why Jem's point about anticipating QE becomes more and more likely down the road, because we're seeing the bond vigilantes globally out and about. Like, it's obviously not a problem in the US right now because we have an administration telling us their primary goal is to bring down growth and actions reflecting that. But if this is the environment they're going to have to cut rates into or provide liquidity into on a global scale, I think it's just fixed income investors realizing it's finally like, yeah, debasement of fiat. It's higher cost of capital. If you're going to print and spend and everybody's going to get in on the party, then everybody's cost to borrow has to go up at the sovereign level, which certainly has ramifications. As you mentioned, the U.S. is like 4% of the world's population, and our equity markets were like 60% of the global equity cap. And these imbalances can persist for very long periods of time. But if there's meaningful near-term things, i.e., tariffs or protectionism, that instigate a reversal of these trends, then it can, the unwinds can prolong as well. And that doesn't seem like it's a flash in the pan. I think, yeah, the U.S. equity bull market, and there's knock-on effects for crypto and everything else, seems to, yeah, at a very minimum be extremely injured, and at a maximum be over.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah. Yeah, for sure. I want to float around, and I haven't actually heard your view too much on this yet. I don't think we've chatted about it much lately, but yeah, like how much do we think about this growth outlook? Like, recession versus growth scare versus growth slowdown. Like, the thing is that where we're starting from here is like a GDP growth rate of 3%, which has been above trend. and like that. So there's a lot of breathing room for it to decelerate. And yeah, like out of those three, where do you sit in that camp right now?
For me, it's going to depend on how quickly and what action we get at when the powers that be kind of say uncle to this pain. Like that's, I think, where you have to be looking next week at the Fed meeting. Does Powell, is the Fed sort of still very content being just in a like patient, sure, we'll cut 25 in May and then we'll see, and then we'll cut 25 in July and then we'll see. Like, what is their cadence and their willingness to step in proactively? And same with the Trump admin, because uh, there's a number of things they can be doing that would support markets a lot more than ripping off tariff announcements helter skelter. And I think some of that is a distraction to what they're trying to do on the budget cuts. And one of the points I was making yesterday was, if you're trying to appeal to a base of voters, would you rather have them believe the economic pain is because you're protecting their interests on the global scale with tariffs and taxing external international adversaries? Or would you rather have them know that the growth scare and the markets issue is because you're trying to cut all these jobs and domestic growth from the largest provider of new job creation in the US over the last few years, which is the federal government? So there's a lot of politics going on, and Trump's strategy of going full bore, having all these irons in the fire at once so people can't, the little bit of distraction tactics, I think, is real. And people are cued on the tariff headlines, but I actually think it's the other stuff that's probably driving bigger fear. I mean, we saw Delta with their earnings, talking about it. More companies are talking about it. So for me, it's hard to envision a 180 from here that gets us back rip roaring. I mean, it seems like there's real, like getting the 10-year down is not a 2-month thing. Like
No,
it's down
no.
20 bips. Getting rates to a lower trajectory is yeah. So I think if they want to really achieve their goals, they're going to have to stair step this down and down 10, up 5, down 10, up 5. Like if they just let the thing crater, then they're going to have to, then tax revenues are lower, the deficit's then higher. They have to come in with bigger stimulus, bigger liquidity to rejuvenate things. And you basically just back at square one because you reversed all the progress you made. It's a tough place, because when you indicate to the market that you're going to run this controlled burn, you basically have the market cued off your every word. And so everyone's basically saying, okay, fine, I'm not going to participate and buy more until Trump, because they're just raising hell.
Trump basically tells us to buy.
Yeah. So then eventually you have to imagine people get so sick of this that they throw in the towel and say, all right, we're puking. And then you get it. And then you get worse outcomes. I mean, how do corporates hire in this environment? How do consumers, book that vacation that their second vacation that they want to take? Like, yeah, I think they're going to start to run into some issues. They've managed the narrative well this far, but yeah, we'll see if it's this easy, which means kind of the longer and longer they go without stepping in, the more risk of a controlled burn. The bigger the controlled burn up in Canada, these fires, if there's risk that it goes uncontrolled. So it's tough to know right now. It's really tough.
Yeah, it's a bold bet, and I don't know. Another thing I think a bit about is, the tariff game is, like, I understand trying to use that as a lever. Like, Trump is somebody that explores, where's the biggest amount of leverage I have, and then how do I press it? And that can work, but obviously, there's only so many times you can put the gun on the table before people stop caring that you put in the gun on the table. And you could try to game out the reaction functions of these economies, and you can go after, like, there's a reason he's focused on Mexico and Canada. It's because those are the highest percentage of trade for the US, so it's the quickest ones to get some progress on. But you have that goal paired with this goal of lower bond yields, right? And then now you're going after these economies that are huge holders of your US debt. So, Canada is this, and I'll try to stay objective here, but Canada is like the sixth largest owner of US treasuries. There's $400 billion on their book. And if to the point of leverage, if you know that your counterparty, their biggest goal right now is to lower bond yields, and you have $400 billion of it that can go against the other side of that, like that's a pretty big, that's another gun to put on the table there. And it would be interesting to see. I got caught up pretty good in a misinformed headline yesterday where there's this talk about Canada talking about bond sales, and it was very misleading because what they're actually doing is issuing global bonds denominated in USD. It wasn't actually talking about them trying to sell bonds, but it did bring up some thought experiments for me about, like, if people get fed up, like at the end of the day, you still have other countries that, ideally the US would want to sell debt to, and at the very least not sell what they already have. And you can try, like, this is a discussion we're hearing about, like century bonds in exchange for economic and military security apparatus over them. And the question at hand, and I'm curious your opinion on this. I know this is long-winded, but yeah, like how achievable does that actually get? Like there's only so many times you can kind of fight your counterparties before they're like, all right, well, fuck this. I'm not buying your bonds. In fact, I'm selling your bonds,
Yeah, I think if you're a prudent country going in negotiations, I got my finger on the sell button all day long. I like hit them where it hurts. Like that's China, Japan. It's hard to say that they're even larger. I'm sure they've been doing that at the table in these negotiations in the last few years, and there's been these bond yield, real yield rate tantrums as a result. So yeah, that's why I just think that it's been pretty smooth thus far in terms of the admin's ability to control the narrative and really press forward from a position of leverage. And I really in all facets of the geopolitical front, right? It's seemingly been pretty smooth. And I just don't think that lasts, because at the end of the day, eventually you have counterparties who can't just give in to the US demands. They have domestic constituents they have to look out for. They have their fiduciaries for their domestic people, basically. So, I mean, even look at Ukraine, Russia. I mean, how long do you think till that's actually settled? It's in the works, but like, is it a month? Is it 6? Like, is it just going to get forgotten about? I mean, take tariffs from 2018 also, right? Like, lead with the big stick, bang them in the head with the shovel on the way in, and then leave with whatever you can get. And by the end of 2018, people kind of forgot. There was a bunch of market turmoil the whole year as uncertainty rose. But at the end of the day, Biden left those tariffs on, and it wasn't 50 or 75. It was, smaller levels on certain things. And I kind of think that's where they land. I think the market's going to push back in a way that's not going to allow such extreme conditions. Or maybe they do think that the risk is they don't go hard enough because they are so early in the term, and this is their window to blame it on the administration, and they are willing to eat more pain than anyone thinks. And maybe that's a 20 or 30% equity market drawdown, as long as it ends with ample room to recover ahead of midterms. And maybe that's their goal. It's tough to say, because I'd imagine Besson is telling Trump, like, if you just burn it down ASAP, you run into these, counter prevailing winds. So
totally, yeah. Like if they really nuke things, we get a recession. Suddenly, the deficit's going to widen a shit ton.
Yeah, like again, I think these things are admirable in terms of cutting waste, cutting fraud and abuse. It's fun. Like it is some of the most interesting thought experiments and keep you on your toes market action I think we've had in quite some time. So there's also like what we think they're trying to do, what they actually do, what the outcome is, and if we think any of it is right or wrong. These are all 4 different things that can all be different, and we can have different views. We could say, oh, well, I think they're trying to do this. They're doing it this way but they don't achieve this. And we think we disagree with how they're doing it or something. Like, so people get caught up in like the emotions of, oh, I can't believe this and that. But usually if you boil things down to like incentives and like what would a logical actor in their shoes do, it starts to make more sense. whether it works or not, or if they just choose the right method to go about, those are easier to debate. But it's definitely entertaining.
Yeah. Oh man, no shortage. Okay, I want to bounce around this, long the rest of the world equities, short Mag 7 US exceptionalism thing, because I'm still fixated on it. And here's the thing, like you look at this chart here and you got the DAX on the top and SPY on the bottom. And I think that the short-term trader in me says the trade's done. Just as people are really starting to talk a bit about it, it's like, okay, you got the mean reversion trade where, there's just everybody was piled in on US exceptionalism going into the year. Like if you just look at the data, like just like everybody was like, okay, you just hide out in Mag 7, don't own anything else. And then we got the mean reversion kind of squeeze as SPY fell apart at the same time that like these foreign currency, like we already talked a bit about this earlier in the show, but like, if a European is buying Mag 7 and it's currency unhedged and then the euro rallies into it at the same time that their Mag 7 is going down, their losses are being amplified, right? So there's like this big squeeze going on. And so it starts to make sense why you've seen this dispersion. But I don't know, man. I'm still like really excited about the Europe trade because I have a feeling that a lot of people are mid curving it, and this is sort of going against like we had Tony on last week, and he's on like USA rah buy US equities, and I'm pretty convinced of that. But I look at the shifts that are happening, and these are big shifts that go against like a 10-year trend, which is basically fiscal unshackling is what I've been calling it in Europe, and I just feel like that's not something you price in a month. That's like a multi-year dynamic, especially when all the capital is on one side of the boat. And, these are big ships. These are target date funds that just like own Mag 7 and hide out on it. They can't just market, sell, and rotate in a week. So I don't know. I'm still I feel like, yes, the easy money's done, but I feel like the trend is just beginning and people are mid-curving it. But I know that can also be said at a local top. So I'm curious your thoughts.
Yeah, I think I saw someone talking about Chamath, talking about Germany or like German assets or something. And I was like, geez.
It's over. Yeah, exactly. So
yeah.
There's those short-term things that are popping up.
I think I would agree with that sentiment. Like it's easy to simplify these things down as like US international or Europe, US, Asia, US, South America. Like all these countries are different and there's extreme dispersion across each market. So I do think there's a lot of opportunity there for the reasons you mentioned. I do think we're in sort of a secularly weak dollar environment. I think you probably do want to exercise caution in terms of like how you trade it outright versus relative. In both cases, I would guess that this is not such an opportune spot to be buying Europe, just given the run it's had, and particularly relatively because right? If we're sort of at, like we talked about this negative reflexivity, if the market just keeps puking and then that affects the economy and everything, like if the US goes in recession, like actual recession, that's not going to be great for global. I wouldn't expect.
Everything's going to be hit in those type of margin calls.
Yeah. But I don't at this point expect a full recession yet. I think we need a little bit more information on what policymakers are trying to do here, but so far it's pointing towards it, given how far behind the ball the Fed is. I mean, so yeah, I think directionally you're accurate. I think there's opportunities in EM and elsewhere that might even have cheaper and more interesting multiples and opportunity than say Europe. So it just kind of market dependent. I mean, think about this, right? Like to give context, how far behind the ball the Fed is. This data we're seeing in this, like in January and February and the short time in March of this weakening effect is lagged pre-Trump anything. Like, so the Fed not only is behind the data that we're getting now, the Fed is behind not even accounting for any Doge negative effects, tariff negative effects, and like overall Besant, we want to bring growth down negative effects. So like they're sort of doubly behind the curve here, in my opinion.
I fully agree. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. That's the biggest thing that's got me bearish right now. And I don't know about you, but that feeling of complacency and lagging from the Fed I felt that way since like December. Since that December meeting, it's kind of felt like the trigger. And it's getting like, to your point, we got the jobs report last week, and during then, the U6 unemployment rate, which includes employed part-time for economic reasons, is the big one there. That had a huge surge. And so now the U6 unemployment rate is higher than it was in last September when they were doing 50 basis point cuts. And now you compare it to like Powell last week, and I don't know if you listened to his speech on last Friday, but he was chilling. He was just like, there's no reason to be overly cautious right now. We're happy where we're at. The economy's doing fine, and we're sitting on our hands, and we don't really care what's going on right now. Like, you don't want to own risk in that environment, I think.
Yeah, he's literally saying, I mean, yeah, it's probably, it's probably no coincidence that the whole Trump admin has sold all their assets just in time for some mayhem.
Even Jamie Dimon been nuking the JPM.
Yeah, all the Mag 7 CEOs, everybody, every insider, this Palantir, everybody. They should be, right? I mean, good time sales. It's tough, man. Like, I think what people are mentally transitioning into now is the realization that, oh, wait, this isn't maybe a dip to be bought so hard. Like, oh, this isn't just a hiccup in markets because of Trump's boisterous tariff negotiating strategy. This is actually forward earnings being clipped, probably in the worst way we haven't seen in a bit. And, oh, by the way, expectations and estimates were the highest in like a decade plus on revenue and earnings going into the year for growth. Oh, on top of that, multiples were at record 2021 level highs,
and everybody was long
painted on those record high earnings and revenue growth estimates. So that's what I think people get confused or maybe don't acknowledge as much as they should as to how overextended the positioning was in U.S. assets. I mean, just remarkably overbought, overvalued. So this isn't that unusual. Like,
yeah, I mean, when you paint the picture that we have here, right? So we just talked about the Fed. They're sitting on their hands, not doing anything. As things deteriorate, that's the point of tension. Like, it's fine if they sit neutral when it makes sense, but I think we're both on the camp that it does not make sense, and we can argue if that's political or not. Who knows? Only they know in reality. But you kind of put it together and it makes sense. Fiscal tightening is happening, even setting aside like the Doge stuff and the tariff uncertainty, regardless. And this is something I'll tell you, I interviewed Vincent Delaware this morning, and he had this really interesting framework of how, setting aside that, the reason he was in favor of fiscal tightening coming is because of the residual of state level spending from COVID. So basically that all ended in the first quarter of 2025. And that's the residual. That's why, like, I don't know, it's not a conspiracy that most of the job gains have been state level employees. It's just literally they had a shit ton of money sitting in their balance sheet because of COVID stimulus. They got to spend it, and they can spend it. So let's go hire people and do things. And that's ended now. So regardless, he was saying that those, that fiscal impulse was growing by like 43% over the last 3 years. And then in 2025, it's actually going to decline by 6%. So setting aside what Elon and Trump are doing, that's coming regardless. So we know there's this fiscal tightening happening. We know the Fed is neutral at best within it. The liquidity picture, which we can maybe talk a bit about here, is, I think, flat at best. There's this TGA drawdown thing, but it's not really doing much. It's a lot of it's moving into the RRP. It's not going into the broad market at all. You still have QT happening. Yes, maybe they'll pause for a little bit. The liquidity
stock
backdrop
market down 10%.
Yeah, exactly. Yeah,
job
exactly.
unemployment rate, that's not good for liquidity. Like, yeah, dude, we had this conversation like 3 or 4 weeks ago when we were talking crypto outlook and everyone's gung ho, and we're like, yeah, that's just the distribution of possibility return shares is extremely unfavorable, and I think it, you can say I had so some of this guy has been texting me like every week since I've been bearish for like 5-6 weeks. Like it started like, hey, so are you really that bearish? Oh, okay. And then the next week it's like, uh, hey, so you think it continues? And then like it's transformed to please tell me when
Yeah.
when are you stepping in? And then like it's like, tell me you got to be getting bullish at these levels. And I'm like, well, there's a difference between getting more interested at buying value prices. Like I want to be a discount shopper when it comes to my investment portfolio. I want to buy things when they come to me, but that is different than taking an asset off your hands because you're barfing it because you can't hold it anymore. Is different than me getting extremely bullish. Like, oh my God, we're going to rip face. Right. So like, I think we're in a bear market and no one really recognizes it. And when they do is probably the time to buy. Like that's sort of
Mm-hmm.
my,
And then even then, you got to be ready for the time-based capitulation because, like what we just talked about, that backdrop. Like I'm the same. People are like, okay, you bullish yet? And it's like, yeah, maybe we'll bottom soon, but the V reversal is not coming because that backdrop that we just painted has no signs of changing whatsoever. So, yes, you can buy if you're looking at Bitcoin, you could buy the 70K big support zone. But you got to be ready that you're going to be tested that positioning for multiple months. I think, like you will get a flush. If you buy 70, I wouldn't be surprised to see a flush into the 60s and then come back and then chop around and then maybe go up a little bit on some weird random thing and then come back down a bit. But you're not buying 70 and getting the sell at a 120 in 3 months. It's
yeah,
just
no,
that's not the backdrop we're in.
yeah, no. I mean, so and then people want views and stuff on it. And it's like, well, I kind of just view this year as just everything's trading. You can build the best thesis you want on whatever US stock or crypto asset you want. And I'm not really sure anyone cares. I think with everything prevailing, uh, yeah, like it's a trading environment. I think it's going to be that way for the large part of the year. It's not a like, oh, I'm going to buy this because it's cheap and it's going to go up 2x in 6 months. It's not a momentum environment. Maybe
Yeah.
momentum to the downside, if anything.
Yeah. So are you buying anything yet for at least a trade here, or still just waiting for the dust to settle?
We're nibbling. We're doing stuff. We're active, but probably should just sit on hands and be less active usually in these situations. But I mean, we're trying to make money, and but nothing from like I don't think we're in deep value for any asset yet. Does that mean there's going to be 5 or even 10% bounces that you may or may not catch or play? And uh, some of the most vicious rallies are counter trend bear market rallies that suck people in, that will go plus 5 to 10% in days on short squeeze, turn into chasing, turn into FOMO, and then puke right back down in a couple weeks. So like the volatility, if you're trading, is pretty awesome.
Yeah, that's always such a classic thing I find funny about bear markets is you'll get those green days counter trend, and the books are so clear that it's just like it just gaps and it goes up 5% in a day on like SPY, and people are like, oh my god, look at this strength, we are so back, and it's like,
Yeah,
no man, I want the slow grind 70
yeah,
basis point
unhealthy.
days. I don't want the 5% dead cat bounce. That is scary to me.
Really unhealthy. Yeah, the gaps up pre-market is bad. Like the chasing at the end of the day. Like, yeah, it's a be patient. Like I just continue to believe like the market just did a fabulous job of training people to buy the dips for 2 years straight with no drawdowns and up only record risk asset returns, and that's just has to get tested at some point.
Yeah. I want to talk a bit about bond market and where, because I feel like we both kind of keep going back and forth on what parts of the curve to play there, how we're thinking about it, because this hawk to a trade that we started talking about in like December, right? Which is that the Fed hawked, so I bought Tua, which is a ticker to basically get like leverage exposure to the 2 year, which is the cleanest way to get like exposure to Fed rate cuts. Because if you buy the long end, there's a lot of other things going on. But if you focus
Home
on the
run
2 year,
trade, by the way,
I know we
for
like,
a bond move.
yeah, certainly. Basically what happened was like during that initial surge in yields after the election, we started to have the 2 year touch the Fed funds rate, which there's a lot of different ways you can view that. But my simple heuristic is, okay, for the 2 year to start going above the Fed funds, we need to start at least thinking about hikes, and that was totally off the table. So it's like, okay, well you can go in size on the 2 year there, and your upside is extremely limited, or sorry, your downside is extremely limited because your downside is a hike, which is, I don't know, very low probability. So then you run the decrease in yields on the 2 year, which is what we've seen. We went from, what is it, 4.38 to all the way down to 3.8. So that's been a pretty good one. But now we have, we went from 1.5 cuts baked in for 2025 to 3. Curious starting there on the 2 year. Like, do you think 3 is too many cuts or too little?
It's probably a ballpark where I would say occurs. But also keep in mind that there's normally a premium in the 2 year to the federal funds rate, like in normal course. So I think that interest rates broadly here are becoming much less attractive from the long side. I guess maybe if we get sort of confirmation that they're really serious about actually like really hitting growth over the head, maybe the long end on this bounce in yields is a good long. But it's tough. Like, do you want the trade is the money's been made, like you going 4.3 to 3.9 and you get 40 bips. Like, you want to squeeze 3.9 or 4 to 3.8? Like, I don't know. It's just not that interesting. I even find that across the board in a lot of assets. Like, okay, the market's down 10%, but maybe earnings are down. Wall Street has adjusted consensus, but like, there's no way in this environment corporate earnings are going to pan out to what they thought they were 3 months ago, pre all this economic growth damage. So, I just don't see a ton of value either direction on the curve right now, to be honest. Like, and I don't really play like the curve moves. I've had a bias,
like steepeners and 210s and those sort of things.
Yeah, it's like,
yeah.
I'd rather just play long the short end on a risk. When I think rates are coming down, because I think they still believe that they're going to cut, and when I'm bearish or pro growth or that view, then short the long end and just pick my weights. But it's sort of too cute for me, the curve trades. At maybe if yields were like 5 to 10% and you had real juice, it's just not my thing as much.
Yeah, agreed.
What do you think?
What about me? The 2 year, I think three cuts feels right. So again, it's getting to this asymmetry. Yes, we could get to 4. If you start to get to 5 or 6, things are really falling apart.
I think people also need to recognize like portfolio composition too here, right? Because
yes,
the correlations between even the long and the short end can be different from each other, and they also can be variable in terms of their correlations to your other risk asset or equity or whatever other assets you have in the portfolio. So, lately, because the government's dead set on slower growth, we've seen bonds and stocks be negatively correlated. Bonds have been providing protection, and that's the traditional thing people think of with 60-40. But yeah, there's situations where that could, if they did have to come with big stimulus, that could be. So you just got to be careful about that, I think, as you're putting these positions on.
Yeah. You know what? I'm a pretty big, where I'm excited about is the 60-40 portfolio here, because underline that. So what's the risk to 60-40 portfolio? It's inflation. I've been the firm believer of this for a few months now, but I think inflation is done. And then, you take 10% out of the equity market and you have OPEC supply deals capping oil, I am still in the camp that inflation is a done deal. Yes, we will get like we talked about at the start of the show. Yes, there's that rebound in core goods. A lot of that is probably also tariff front running, and then now we're getting, if you just look at the terms of trade data that's been coming in, the amount of imports coming onshore, like that's gonna trickle into inventories eventually for corporations, regardless of what happens to tariffs. Those inputs have already come into the economy. So there's a lot of headwinds towards higher CPI. So within that respect, I think 60-40 sets you up nicely for being well hedged for whatever outcome comes, because that's where my focus is at, right? Is that I can't predict the next Trump headline. I can't predict, I can try, but overall, I'm just trying to get to a point where I do okay in any probable outcome. And then around that, I'll trade some speculative positions. But my core book, it's like, okay, if I own some bonds, even though I'm somewhat bearish on the long end, I'm also owning a little bit of equities as well. And that keeps me somewhat balanced. And then, you can try and get cute and play some, 1 week trades and, short Qs or short crypto long it or whatever. But that core correlation bet, I'm sort of excited about the 60-40 idea.
I'm less. I just think right, we just talked about long bond yields went down 20 bips when the stock market went down 10%. I mean, come on. That's not, yeah, relative to the last few years where we had yields going up when the stock market is going down, it's better, but I don't think it's very good. It's not very convex, asymmetric to the downside. I also think, okay, especially from here, and again, the curve, where you're at on the curve matters a lot. But if we're talking longer duration, oil's stabilizing. I don't know, maybe it goes back down. Equities are obviously down, but the bond market is maybe people are selling in lieu of cuts. But what if you fast forward a little bit, get to a time where okay, shit, stuff's hitting the fan so hard, cuts are coming forward. I don't have confidence that the long bond yields go down in that case.
Yeah, fair enough. Yeah.
It just sort of depends on how damaged they let economic growth get. And I lean towards they don't really want to let it get that damaged. Maybe I'm wrong and they're really okay letting things slide, but I'm still of the view that no one wants to reside over a recession, and push comes to shove, Powell doesn't either. Even if, so I lean towards not really loving the long bond here.
So if you're sitting on a book of equity longs, just long-term equity exposure or whatever, just long beta, how are you going to hedge that? Is it just buying tail risk puts and rolling them or something? Or is it volatility? Is it a different asset class? What do you think?
Vol's underperformed pretty decently because everyone was hedged going into this, and it hasn't been that violent. It's been stair steps like Jem talked. I don't know, man. With the equities equities at record valuations, all time type stuff. How do you hedge? I don't know. You can, sure you can. There's just every asset is valued tremendously, hopeful, optimistically. Bitcoin and crypto, and it's all one in the same trade. So I think you either have to sort of play to the conclusion of this next episode. We've entered an episode of not great something, and so there's two options: support asset markets with your policy, or let things continue to flounder. And if things continue to flounder, we're not even close to deep value, particularly on US assets, that makes sense to step in. And gold's had record runs, so I think your best off hedges are probably looking in the places where are just completely unloved, and then shifting your long allocations towards those types of plays rather than shorting or, I think you just have to divest your Mag 7. Not here.
T-bill and chill.
I don't know. Not here, probably. We've
no,
seen a
exactly.
big correction, but
I
don't know.
agree.
Like we said, we're not like bullet. Like it's hard because shorts. So many easy shorts are now down 30%. So you're
Yeah,
like, well, I'm not shorting
just not.
here,
Yeah,
and your longs that you were kind of bullish on are like, well, the outlook's kind of shitty. So do
yeah,
I want to
yeah.
really
There's
like,
no lie. You kind of just have to. I mean, it comes down to time horizon too, right? Like if you're on a
yeah.
1 month time horizon, you got to try to think about something, or if you're on a 5 year time horizon, it's just kind of wait it out. It's too late to sell already.
And this is the bleed thing we talk about. Like this is how the slow bleed happens because you don't have any action to instigate new buyers to step in.
Totally.
Like today, I was saying, so I had a couple messages today that from people like, how could Bitcoin and crypto be down on the day CPI soft? And I was like, more sellers than buyers, I guess. Like it's just like cool. CPI was soft. What did that change? They're not
Yeah.
cutting this month, next week.
Is there,
They're
man? Is there
behind.
any red meat we can give to our crypto brethren that are down 80% and didn't listen to our words of caution?
I don't know. I don't know. It's like I think we're in a bear market, so try and sell
Yeah.
bounces. I don't know.
Do you think that it's a 4 year? Because when I look at the macro situation, I feel like 2026 might not be a bad year for Bitcoin at that point. And if you think through the long term macro framework that we just talked about in terms of like the Fed fiscal liquidity, that goes completely against the traditional 4 year cycle that Bitcoin has followed historically. Typically that's like the absolute doldrums of the bear market. Do you Are you fading like the 4 year cycle at this point?
I don't think this cycle's been that different than timing wise. Like it's been
Yeah,
the bottom was December 2022, and
yeah.
we have gone to like 6, 7x that highs. Like that's a pretty awesome. Like people are like,
Yeah.
oh, the cycle hasn't started yet. I was like, well, just because the stuff you own
Just because
is that
every alt didn't
close.
go up
Yeah,
100x doesn't mean it didn't
like
happen. Yeah,
everybody in the real world's like, yeah, the stocks are at all time highs. Like the cycle's been going. But here's a different mental model that is unique that I haven't heard before, but I believe to be true is this look, this crypto cycle was a let's call it a kneecapped or like a less powerful one from the get-go because of how it started. How it started was basically covert slash non in your face monetary and fiscal policy. First in October 2022 with the gilt crisis, the UK gilt crisis. Then in 2023 with the banking crisis, and then October 2023. So it was this combination of actions that were no crisis or real loss of trust from governments. It was sort of a piecemeal liquidity time period, and we still managed a very really attractive um, cycle, and if you played it right, and here we are staring now down the barrel of what I believe to be a more treacherous period for liquidity driven assets, where you have growth slowing and but what you do have is the prospects of, in my opinion, a bigger crisis than we've had in recent times. I'm not talking the next 3 months. I'm talking like within the next year to two. Just given, right? If we haven't had this potential for negative reflexivity that we could have over the next year or 18 months in a long time. I mean, it's been there, but they've stepped in. And so now the question
yeah.
becomes, from a psycho theorist perspective, does do the government bodies, does the Treasury and the Fed continue to do these piecemeal things like they've done over the last 2 years, where it's like, okay, we go down 30, 40%, and then we get some liquidity action and we're up there, 50, 60, and then we chop, like, or is it like the Fed saying, look, inflation's too high for us to keep cutting, growth isn't dinged yet enough, and then it creates this reflexivity, and then we have a bigger problem, and then they come in with the bazooka liquidity, QE, rates to zero. Like it's
Hmm.
unclear which path this takes, but what I'm saying is at least maybe hopeful for crypto participants. It's not near term, but it's out there on the horizon, that the potential for a bigger liquidity cycle than what we had driving this bull market. And who knows if, people might be so burned by VCs and crypto scams and shit by then that like maybe it doesn't flow, maybe it flows into AI and something else, but like there's the potential out there.
That potential is always there. It's just the issue with being excited about it is that or at least we know that things have to get a lot worse before they get better.
Exactly.
So you can't just own alts waiting for that, because it's going to be down another 80% before that actually happens. So if you're excited about that prospect, you have to know that it's going to get so much worse before that actually comes to full.
Yeah, that's not a rosy outlook. It's just like explaining why this cycle was not what everyone wanted it to be. And
totally.
But, as much as the sun rises and sky's blue, we know what policymakers, actions are in times of crisis. So,
yeah. I mean, in terms of long, I don't know if you call this just like the long Ponzi trade, like we did pretty good compared to other Ponzi's, like, ARK, ARK ETF never really got going, never broke all-time highs again. So with respect to what you say about this piecemeal liquidity thing, I think we had a great cycle,
Yeah. It's, I mean, Bitcoin was like,
I feel very happy with how I did.
Well, people also, I see all this like sentiment, like, I can't believe, like, we hit over a 7x off the lows. People, I can't believe Trump's, I wish I would have had Kamala for crypto and all this stuff. It's like, dude, he gave you an opportunity to sell 109K Bitcoin. Mm-hmm. I mean, what do you think? Like, he's going to just like, come on.
Yeah, you gotta sell the euphoria. That's what we said the week after the election. It's like, okay, we were banging the drum, bull posting nonstop for 2 months straight.
Yeah.
But the second the event actually happened, we're like, hey, hold on, let's chill out here, take some off the table. We won. Expectations can't get any better, so they can only get worse.
Yeah, and I mean, one of the things, we're Lecker's being a global macro fund, and how much time I spend outside of crypto, like probably 2/3 of my time is on traditional stuff, like particularly even maybe more when crypto's, I haven't looked at alts in ages because it's just unattractive. But what I tell people is like, we want to invest in bull markets. Like, I want to be shooting fish in a barrel. I don't want to be shooting fish in the Pacific Ocean. Like that's alts right now. Like I want to go find the bull market. I want to, like, you're talking about maybe some international markets, some, we're looking at other things that we think are unloved right now that will not be unloved in the future. And crypto's not a bull market right now. I think we're headed into we'll see. Again, it matters what policy response is, but there's, for the first time in a while, more potential for a more prolonged bear market than we've had in quite some time. Last year, we had the comfort of they haven't cut yet. We know they can bring the bazooka on cuts. Okay, here, I think they can get 2 to 4 cuts done, but
they're
probably
behind
only
behind the curve too in those cuts.
Yeah, probably only like 1 or 2 cuts under the guise of like support or like normal course, and then the rest come from like real painful damage. So
yeah, I mean, we banged the drum on this, is that in September those cuts were proactive, and we were from a level that was like so high relative to the neutral rate. No matter how you measure the neutral rate, completely different situation this time. And I think, you and I are both not as excited about those rate cuts, I think, because of that prospect.
Mm-hmm. Yeah, 25 here, 25 there. People like, dude, 100 basis points in a okay economy back to back meetings is like, wow. Mix in the most, super animal spirit president at the time was like a crazy stimulus to the market. But things are correcting, and we are getting better levels, and it'll take time. But I think that's that if this continues to prolong, then you get people moving to like, okay, fine, I see what you're doing, throwing in the towel. I'm not looking to buy dips for big bounces. I'm looking to sell rips for protection. And the psychological shift that can occur is then what sows the seeds for bigger issues probably down the road.
Yeah. It's that time-based capitulation. And what I don't see people talking off of is during that time is the opportunity cost, like, yes, you can sit in there and wait it out, but capital is scarce. We all don't have infinity money to allocate to everything. So, shout out to the ETH holders, like if you're sitting in those bags that are the same price as 2023, like, yes, you didn't lose money, but man, your opportunity cost did, and that's permanent.
Yeah, I mean, you did because your purchasing power inflation is not
Or that. There's also that. Yeah.
like
Yeah.
it's
Oh,
man, yeah, yeah. You
you
got to
can't
lose
do
the
anything.
emotion. You got to lose the
Yeah.
emotional attachment to the bags real quick
Yeah. Exactly.
because that ain't correcting. You look at that chart. That's like you invert that chart. It looks like yeah.
Yeah. Pain. All right, man. Well, let's leave it at that. See you in Das. See you in New York. Hope everybody's there. It's gonna be a ton of fun. I'm excited.
The Big Apple. The Big
Big
Apple.
Apple, man.
Looking
Yeah.
forward to it, man. We'll have fun.
Yeah. Yeah. It's gonna be a good one. See you all there. Make sure you come out to the meetup. Make sure you come out to the live roundup. Yeah, there'll be lots going on. See you guys there.
Sounds good. Have a good weekend.